All right, everyone. Hello, and welcome to the second screencast for Chapter 22. Chapter 22 covers savings, interest rates, and the market for loanable funds. And in this screencast, we're going to use the supply and demand model to look a little more precisely at the market for loanable funds. So here it is. This is our supply and demand diagram that we introduced in the last screencast. And remember that the suppliers here are households. They're you and me investing our money, putting it into banks, putting it into stocks, putting it into bonds, any kind of financial instruments. That's the supply side of the model. And the demand side are firms who need loanable funds. They need extra cash in order to put them toward some sort of productive business use. So that's the supply side and the demand side in the supply and demand model. All right. And again, this is just a good slide to have when you're studying that kind of summarizes everything on one slide. So just as we did back when we first introduced the supply and demand model, let's take this one side at a time. And I'm going to start with the supply side. All right. So remember that movement along the supply curve is a change in the quantity supplied, but it's not a change in supply. And if you remember, moving up and down a curve, here the supply curve, is caused by a change in the price and only the change in the price of this good. All right. So movement along the supply curve is caused by change in the interest rate. So if you're looking at a question or trying to think through a real world scenario, and the only thing that is changing is the interest rate, then you're only changing the quantity supplied. It's not changing supply overall. That would be a shift in supply. The price of a good changing, if only the price of a good changes, say it that way, then the only thing that is changing is the quantity supplied, not supply overall. All right. So what does shift the supply of loanable funds? What shifts the entire supply curve? What causes households to want to supply more funds at all possible interest rates, right? That's what a shift in the supply curve would mean. And those can be caused by changes in income, changes in wealth. It can be caused by changes in time preferences. People get more impatient or more patient. It can cause shifts. Also, we're going to look at something called consumption smoothing. All right. So what I'm going to do over the next couple slides is we're going to take these three things that shift the supply curve. And at the end, I'm going to give you a chart that kind of maps each of these into whether it shifts it to the left or shifts it to the right. All right. So first, let's talk about changes in income and wealth. All right. So increases in income generally increase savings. As people get wealthier, we tend to see that people tend to invest more. They have more disposable income, and with that disposable income, they want to put some away for the future. Also, time preferences. Generally, people prefer goods sooner rather than later, and they prefer funds sooner rather than later. All right. Time preferences are not uniform across individuals in a society. We all have heterogeneous preferences for how quickly we want a return on money, on when we will need to use money that might have been disposable income, so we put it in savings. We might have different ideas about when will I need that money next. Is it in a year? Is it in 10 years? So within society, people have different preferences over when they want their money back. Less patient people will prefer now to later, and they're going to save less. All right. More patient people prefer to have the money later, and they're going to save more. Time preferences help determine what the overall savings rate is within an economy. All right. So let's think about time preferences with a particular example, and that's one that's probably pertinent to a lot of you, or recently was pertinent to a lot of you, and that's the decision whether or not to attend college. You can also think of this in terms of the decision to get a graduate degree or whatever is applicable to your situation. All right. So option one is, well, just go get a job and earned income immediately. All right. You can consume things now, right? You can buy a car, you can buy a house, depending on how well the job pays. All right. Or the other option is you go to college, all right? And for the most part, you're going to forego a good bit of income and you're going to forego some consumption while you're in college. I worked full-time through undergrad, but I still forewent a lot of income because the job I had wasn't a high-paying career kind of job. It wasn't a skilled trade. It was working retail. All right, and so I forewent, maybe is the way to say that, any income that I would have made above what I was being paid to work at a toy store, which is where I worked through my undergrad. Whereas I had friends from high school and from other places who didn't go to college. They started working, some of them in skilled trades, and they were able to buy houses and buy cars much earlier than I was able to do that sort of thing because I was going to college and I had to forego some of that income. And without income, you can't consume, so I had to forego some of that consumption also. And of course, this whole scenario is kind of assuming that the person is not being supported by someone else. Many college students are supported in different ways by their families or spouses or what have you. But in this scenario, just think of someone who's pretty much supporting themselves. Also, when you go to college, you're going to have higher future income and consumption. That's sort of the idea, right? You go to college, you forego some of that income in those 4 to 6 years, depending on how long it takes you to get through undergrad. But it's a similar thing also for going to grad school. You may not be foregoing career income because a lot of people in MBA programs and other graduate programs do work full time during the day in their careers, but you're giving up other types of things like time with your family, leisure time. All of that counts. We count those sorts of opportunity costs in economics. But you're doing all of that in hopes of having higher future income than you have now, and then being able to consume at a higher level than you are without having the college degree or the graduate degree or whatever it is that fits your particular situation. All right. So this brings us to an idea in economics that we call consumption smoothing. And the idea with consumption smoothing is that you don't want to have large changes in your consumption when you have large changes in income, right? So the idea is that your income is going to change a lot over your lifetime. When you are a kid in high school, you have hardly any income. When you go to college, you don't have a lot of income. Then you come out, you start working, your income goes way up. Then you're going to, as you get older, you might partially retire. That's a really common thing these days where people don't just quit working altogether. They may start up a business or do something else, but usually they aren't making quite as much as they made in their primary career, and so your income goes down. But the idea with consumption smoothing is we don't want our consumption to have that kind of peak and valley. All right, we want to smooth our consumption over our lifetimes. All right, so income changes a lot over your lifetime. We don't want consumption to change as much. And so economists have built this model of consumption smoothing. It's a kind of complicated mathematical model on the theory side, and it's a little bit complicated on the statistical side. But we don't need to do that. I can show it to you really easily with a pretty simple picture here. And so this is your income and consumption. I'm going to have 2 different functions for each of those that I'm going to graph on this axis. And here we have your early life, your prime earning years, and later life. And of course, when you're doing this in statistics or you're doing this in a more precise mathematical model, you might want to map exact years on here, but we can get the gist of everything just by graphing this with early life, prime earning years, and later life. And so what does income look like in this situation? Well, income tends to have this sort of profile. And again, this is for the average person. We've all known people, I'm one of them, who my income profile doesn't look like this, right? Because I went to graduate school. It took 6 or 7 years for me to get through graduate school. Then I took postdocs. So my income doesn't quite look like this. But for the average person in the economy, this sort of profile fits the average person. All right, their income is low in early life, then it spikes way up in those prime earning years, and then it falls a good bit later in life. All right, so the idea with consumption smoothing is to make our consumption not follow this sort of pattern. All right, and so what we would like to have is that our consumption look more like this. All right. And so what does that mean? Well, it means I want to consume at a level that's higher than my income early in life. All right. And sometimes people do that through their parents, grandparents, spouses. They do it in different ways that they're able to, I guess not spouses super early in life, but maybe by their college years. But that means you've got to make up this difference. All right. And again, for this story, let's assume it's someone who doesn't have parents that are supporting them. Well, how do you fund this level of consumption when your income is this low? And you do that through borrowing. All right. So we borrow money in this phase of our life. That could be student loans. That's a really big aspect of this borrowing early in life in our economy these days, as there's a lot of borrowing to fund your living expenses and tuition in early life. And then this area is your savings. All right. So when your income goes above your consumption level, all right, then you can take this money and you can save this money. And this is the money that is now going to go into the loanable funds market. All right. And then, of course, after saving, you put that money away, and then in 5 years, 10 years, 20 years, you get that money back plus any interest that is accrued on that money. And then you are able to spend that money down. And this is called the dis-saving portion of the consumption smoothing model. And this is where you're not having to borrow again, hopefully, but you're able to spend down this money that you saved plus the interest. And so this is called the consumption smoothing model. And so I promised you a graph that would put all of the supply side factors of the loanable fund market, the things that shift the supply curve, here on one slide. And so income and wealth can change the supply curve, and it's a positive relationship. So when income goes up, the supply curve shifts to the right. All right. When income goes down, the supply curve shifts to the left. So the supply curve moves in the same direction with income. That's what we mean here by positive relationship. The variables move in the same direction in the model. With time preferences, there's a negative relationship. All right. The lower time preferences indicates that people are more patient and therefore want to save more. So as your time preference goes down, your preference for consumption today, that's the way to think of time preference. It's a measure of how much do you want to consume things today. Well, when that goes down, your savings goes up. If the time preferences for a lot of people in the loanable funds market goes down, then the supply will shift out. All right. If the time preferences for a lot of people in the loanable funds market go up, people become more impatient. They want to consume more today. That's going to shift the loanable fund supply curve to the left, shift it in. All right. With consumption smoothing, we see a positive relationship also between the supply of loanable funds and this variable consumption smoothing. The more that people want to consumption smooth, the more that they need to save in that middle part of their life, in those prime earning years. All right. So income varies over the life cycle, but as people want to consumption smooth more, the supply curve will shift out to the right. So there's a positive. Those variables move in the same direction. All right. So now we want to move on to the demand side. All right. The demand for loanable funds comes from borrowers. It comes from firms that want to borrow money to invest in their firms. It's driven largely by these firms that they have big capital projects. They want to build a new building. They want to build a new warehouse. They want to build a new factory. All right. They need to scale up their workforce in a really big way. All right. That's where the demand for loanable funds come from. They can't pay for those things out of their normal revenues. They need a big chunk of money that they will then have to pay off and pay down with revenues over time. All right. So governments also borrow from the loanable funds market. And recall that borrowing must occur to build these capital goods, and this occurs before production of final goods happens. All right. So let's look at that demand curve. Remember, as the interest rate changes only, if nothing but the interest rate is changing, then we're just changing the quantity demanded of loanable funds. We are moving up and down the demand curve. All right. It's caused by a change in the interest rate because the interest rate is just a price. So just like way back at chapter 3 or 4, when we did the demand curve originally, we said, well, what happens if only the price changes? You're moving up and down the demand curve. The demand is staying the same, but the quantity demanded is changing. Same exact thing here. The interest rate is a price. When the interest rate goes up, quantity demanded goes down. Law of demand, right? When the interest rate goes down, quantity demanded goes up. Law of demand, all right? So that's what causes you to move along the demand curve. So the first thing that causes a shift in the demand for loanable funds is the productivity of capital. All right. Remember, capital is what firms are buying or investing in when they borrow money from the loanable funds market. They're building a new building, they're building a new factory, whatever it is that they are using this big chunk of money that they need. Whatever they're using that money for, that's usually capital, all right? So if that capital becomes more productive, it means it's going to become more profitable. And if the capital investment becomes more profitable, then firms are going to have a higher demand for loanable funds so that they can build the building, they can build the factory, they can build the warehouse, whatever it is they need to do with that money, all right? The returns on their investment in those capital goods will be higher, all right? And so that will cause an increase in the demand for loanable funds. An example might be the internet and computers. When the internet came about and computers became common in businesses, those things were highly, highly profitable. They really increased the returns on investment for different businesses. And so that caused a spike in the demand for loanable funds. The other thing that I said shifts the demand for loanable funds is investor confidence. If a firm is really optimistic about the future, it's going to borrow more today. All right. If they're optimistic that sales are going to increase, if they're optimistic that the returns on capital will be high, then they're going to want to borrow more, and that's going to shift the demand for loanable funds. Changes in in capital productivity and investor confidence are shifting the demand for loanable funds. So let's do a quick thought experiment using our supply and demand diagram for loanable funds. So I'm bringing in the supply, bringing the demand, and bringing in the interest rate, the price of loanable funds. Here it's at 5%, and there's $250 billion worth of investment at that interest rate price. All right, so that's going to be our setup, and we're going to change one of those shifters that we talked about. We're going to shift supply, or we're going to shift demand. Then we're going to see what that does to the price of loanable funds, to the interest rate. All right. So in equilibrium, the quantity supplied equals the quantity demanded, meaning that the amount of savings equals the amount of investment that firms are doing with the loanable funds that they get. Supply of loanable funds is savings. Don't forget that. The demand for loanable funds is firms wanting to borrow. That's the investment side over here. So the relationship between savings and borrowing is that every dollar borrowed requires a dollar to be saved. When banks lend out money to firms, they have to get that money from somewhere. The bank can borrow it sometimes from the government. There is a market like that. But for the most part, what banks are loaning out is that they're loaning out money that people have invested in that bank, that they've bought bonds with, or invested in stock, invested in other sorts of financial instruments. All right. So here's going to be our change. So we've got our supply and demand, right? It was at 5%, $250 billion. What if the economy starts to slow and investor confidence declines? All right. What happens to the supply and demand model? And ultimately, what happens to the quantity and the price of loanable funds? All right. Well, if the economy is slowing and investor confidence declines because of that, firms are going to expect that their sales are going to be reduced. All right. So this means that their investment in capital would be getting less productive. All right. So here's the supply and demand model. What will happen? So it's affecting the firms, and when the firms here are the demand side. All right, the firms are the demanders for these loanable funds. And here we have the demand curve in 2007. So this is the great recession story in the loanable funds market. Well, what happens when they see the economy slowing? Their demand for loanable funds is going to decrease because those capital investments are going to be less profitable. All right, they're going to see less of a return on those capital investments. So the demand curve shifts. So at all interest rates, firms are now willing and able to buy less loanable funds. They don't want to they don't want as much of those loanable funds. So that gives us a new equilibrium price, the interest rate, and a new equilibrium quantity, meaning the total amount of investment. So the expectation of lower sales causes a shift in demand, and the model predicts this will result in lower levels of investment overall, and overall a lower interest rate. And we can see that this is exactly the kind of thing that happens during recessions. Again, on most of these time series of macroeconomic data, recessions are colored, are shaded in, and in this case, they're shaded in blue. So this is the recession just after 2001, 2002. This is the recession, the most recent one, the Great Recession of 2007, 2008, and 2009. So we can see here that the real U.S. investment, the demand for loanable funds, really plummeted during this time period. All right, just as we saw in that supply, just as we would have expected by looking at this supply and demand diagram. All right, so this is the savings rate over time in the U.S. So you hear this talked about a lot, how the overall savings rate in the U.S. has fallen over time. It did spike back up a little bit after the Great Recession, but overall there's been a fall in the savings rate. And there's a lot of different explanations for this, but the increase in time preferences is what most economists think. So most people have decided to shift consumption to today. There's a lot of reasons why they might feel comfortable doing that. Overall, the macroeconomy has gotten a lot more stable, absent the Great Recession, which is a big deal. But overall, since 65, we've seen a moderation in the business cycle. And so one of the things going on here is that people feel more comfortable consuming today instead of foregoing that consumption into the future because things might be uncertain. That's only one of the stories that economists talk about, but it is one of the aspects of why time preferences may have changed over time. So that causes a leftward shift in the supply of loanable funds. People are saving less, so the overall loanable funds market, the supply curve has shifted in and to the left. But foreign savings in the United States have gone up over this same time period. This is the savings rate of American households, all right? So some of that deficit in the terms of the supply of loanable funds, or that shift, I should say, in the supply of loanable funds, has been met by foreign savings in the United States. When you hear it talked about that the United States has a trade deficit, and I talked about this in a previous screencast, it's a terrible name for the fact that we import more goods than we export, but it is what it is. It's called the trade deficit. That creates a surplus of U.S. dollars in other places. Those dollars have to be used in places that will honor U.S. dollars, and that is primarily in the United States. So those dollars get invested back into the U.S., and some of that shows up in the loanable funds market. Another thing that could be going on here in terms of declining savings rate overall is that overall our population, our society is getting much older. As baby boomers reach retirement age, they're starting to do that dis-savings part of that lifetime income model that we looked at earlier. And so that pulls money out of the loanable funds market as they are saving less and they are pulling their savings out more and more. So that also causes a leftward shift in the supply of funds. So there's less investment, and if it's not made up for with foreign investment, we would get reduced GDP growth compared to what it would be if people were still saving at the higher rates that they saved in previous decades. All right. So that's just about it, but I want to run through a couple of multiple choice questions just to remind you of the things that we've talked about in this second screencast. So how will an increase in time preference affect the loanable funds market? All right. So if time preferences increase, and that means people want to consume more today, what does that do to the supply of loanable funds? Well, if people want to consume more today, that leaves them with less money to invest in financial instruments, and that decreases the supply of loanable funds that's available to firms to invest in capital projects. All right. So here's another question. In the basic consumption smoothing model, when are consumers dis-saving? What is the part of a lifetime income model where consumers are dis-saving? Is it during their prime earning years, in their 20s and 30s, very early in life, or late in life? Well, dis saving, of course, is late in life. That was over on the right-hand side part of that consumption smoothing model. One more multiple choice question here. What is true about equilibrium in the market for loanable funds? Is it when savings equals investment? Is it when the interest rate equals inflation? Is it when investment equals the interest rate? Or is it when savings equals overall GDP? Well, in the loanable funds market, savings are the supply, the quantity supplied, investment is the quantity demanded, and so what we see is that is when there is equilibrium in the market for loanable funds, and that's what determines the equilibrium interest rate and the equilibrium amount of loanable funds being transacted in the economy. All right, so that's it for the second screencast for Chapter 22. So I will see you later.